I'm very happy to have Alex Leduc back from Perch, founder and CEO. And I realized when I was prepping for the show that the last time you were with us was in February. And it is full visibility. I don't know when this is going to air, but it's Halloween today. And I always say to clients, like, 6 months, let alone a month even in this business is like a lifetime. So I feel like the last time we talked, it was a whole different landscape than when we're sitting right now. So thank you so much.
Well, glad to be back. And yeah, I think we always joke that startups live in dog years. So yeah, 6 months is like a couple of years. So it's good to be back.
Oh my God, right? And I mean, we'll touch on it towards the end of the show, but as I was saying to you, I had a call with one of your colleagues on your team talking about some of these really cool tools that you are oh, and fries are ready. Sorry. That you had, that you're developing. And I'm excited to start bringing them to my clients as well. So we'll talk about that.
Absolutely.
But we started our conversation with the fact that we've had, over the last 2 years, 18 months, the fastest, largest rate increase that we've seen in, is it history? I keep saying history. I might be wrong, but like in decades, definitely in our generation.
Yeah.
But the last two, so the latest one for October, they held flat, which everybody kind of figured.
Yep.
But there were only 2 hikes since the last time you and I have seen each other. And the interesting part is the market has changed dramatically. And actually prepping for this, it made me realize the shift that happened going into the fall. Because I had a client the other day, listings on the market, we are not moving. And this is not about like, not being able to negotiate, people having unrealistic expectations of pricing. I mean, like no one walking in the front door. But everybody is standing still right now. And it made me I was like, only 2 inches. Why did, like in my head, I was like, feels like they've been raising the rates every single month, right? But I really felt, and I said this to you before the show, that the June and July, but specifically the July, even though they were only 0.25 basis points, were the most damaging. Let's go damaging to the market. Thoughts, discussion, let's discuss.
Yeah. So I think it was, so I'd agree from a psychological standpoint, because what was interesting about a lot of the hikes that we saw prior to, so, the ones before February, because those were the steepest hikes that we had, half points, like full point.
Those were the big ones.
We increased
Yes.
quick.
Oh my God. Yeah.
But it was almost like in that context, people were expecting it, because there was just such a high rate of inflation. It kept getting worse. So people were like, all right, something's going to happen. So people were primed.
But we were also coming from down here. Someone's listening. They don't know. But like you were coming from so low. Yeah. Like, and I used to say at that point, like money was literally free.
Yeah.
So people were like, okay, a basis point, like, right? We were free. So now we're not so free, but like still really cheap, right?
Yeah. But I think you're right though. What changed in the June, July ones is June was kind of 50. People were, it might happen, it might not. But July, pretty much everybody thought it wasn't going to happen. So usually when things happen negatively that are going against what people like, that has a deeper effect, because then they go, well, what else did we get wrong? Or what else could happen that we didn't see coming? So I think it has a bit of a psychological effect where people start like, we talk to clients who are like, oh, what if rates go to 10%? Like that's so far away, but people start extrapolating like how bad it could get.
But I think when you're told, and this is why I wanted to do this episode now and why I wanted you to come in, because, I'm shifting from, an education of like how the buying process works to literally the education on, how you get approved for a mortgage, what you can afford, what's happening, what's that crystal ball in my over decade, 12, I can't remember how long I've been doing this anymore, but like I've never had so many of my clients come to me and have those conversations. What if, how do I do this? How do I do that? Never worked with mortgage brokers as closely as I have now and kept up with it. So, and I agree. First of all, as much as this is about investment and budget, and it's still four walls and it's still where you are going to live and it's still your money. And I still say that 90% of this business is driven by psychological. Yeah. It's why no business happens during the summer, because everybody's out having a good time, right? It's summer. I'm not in that mind space. Or why everybody's into it in spring. Like literally, like everybody buys in spring. And I was saying to you, I go with the flow. And I think most people went with the flow for a long time, and you expect like prices go up, they go down, and they go up, go down. I was angry in July. I think that I, along with everybody else, had lost faith in what they were telling us. And I think that that's where, people went into July and August and went, I'm done. Right? Like I've had it, right? Like we have 2 more interest rate hikes and it's possible that it could happen.
Yeah.
Thank God it did not. And I don't think they will in December.
Yeah. Well, actually, it's crazy how much, like even in September, everybody was convinced there'd be one in October. And then they held steady. And I mean, as the data comes out, it's just, so we reforecast on a monthly basis. Mm-hmm. And it's mind-blowing actually how much the forecast can change in even like a 3-month period. So we see it all the time. But yeah, I mean, right now the market is still pricing in like another quarter point, like by year end. Except I think they'll hold tight. Like I think they're done. I think it's going to basically just hold still until like the second half of next year is kind of where the outlook is.
I think that if they were to raise, and believe me, there are people a lot smarter than me that you should listen to, not me. But again, just from a rational standpoint, I think that, so first of all, they would kill the retail sector for December. Yeah. As it is, people are not spending anymore. You hear, and I hate to be doom and gloom, but you go to restaurants, you hear people are not busy, that you can get, reservations, people are pulling back, they're feeling it. GDP held flat. I am sure that we will go into a recession early next year. So the interesting thing to me is if you're going into a recession, and we've been very overdue for one, if you look at the cycles. We were due for one right before COVID, I think, right? We were overdue. Mm-hmm. Can they, are they raising rates in a recession, right? I mean,
no,
if they'd halting,
be for sure cutting, yeah.
Right, exactly. Are they, as we see, the debt rise, are they going to continue rising? I find it so hard to, and it's not to say it's not going to happen, and maybe it's just wishful thinking for me, but I speak to clients all the time. People are really struggling.
Yeah, well, because it affects everything, right? So it's people's cost of financing, which is, the one of the largest expenses is their mortgage for most. And then on top of that, it's also just businesses in general. Like a lot of them have financing on the business as well. So people that took a hit during COVID had to rack up debts. Some of those debts are variable rates. So it's
restaurants.
Yeah. Oh yeah. Restaurants, like a lot of retail.
Gyms, yeah.
Oh yeah. And some of them have never come back fully from where they were before. Right. So we're seeing it all over the place, but because I think what we're seeing the most is on the business side. So purchases have slowed down, but we where we see refinances is it's not like, I call it positive refinance, where it's to do home renovations, buy rental properties, like it's refinancing for growth.
Interesting.
Whereas we see a lot more debt consolidation, reamortization, like basically it's survival, where it's not to grow, it's more just to be able to stay still in some ways.
Yes, I think everybody's holding on with their fingernails right now, for sure.
Yeah.
So that kind of leads me to my next thought also was, I mean, we saw in the October numbers, we saw in the September numbers. So I'm very interested, and I think we'll see the same trend come out in the next couple of days from Treb on the October numbers, which still are like rearview mirror. But I mean, we saw 44% increase in listings. We saw a decrease in sales volume. I think we're going to see a steeper decline in sales volume year over year. Personally, like I was selling steady in the fall of last year and did not see this kind of lack of activity. Things are selling, but it's very different. Yeah. What are you seeing in the sense of like purchasing or clients? So you say there's some in the sense of growth, but knowing that people still want to own homes,
Yes.
are you seeing the same amount, more or less, like reach out to you and not get qualified? Like, what are you seeing in the sense of volume on your end?
Yeah, so so year over year we're actually still growing quite a bit. So I mean I don't want to. It's not really the macros. It's just because we're still in hyper growth mode, right? So we'll
Fair.
make the best out of any market kind of thing.
Sure, sure.
Overall, the industry is like it's a smaller market share. So like across the board, mortgages have less volume for sure. But I think what's interesting in the dynamic with our customers is so the first thing we're seeing more of is we're kind of having to reshape how people think about housing. So what's interesting is Mortgage Professionals does a survey every year, and they ask people, "Do you view your home as an investment?" And I think the number is only 20 or 30% of people that say yes.
Across Canada?
Yes.
Oh,
So
that's why.
yeah. So it might be it
I
might
was going to
be
say all the
locationally.
20% were in Toronto or Vancouver.
Yeah. So, but what's interesting though is because if you look at the return on a property, it's a mixture of capital gains and yield.
Right.
And historically, when you have really low mortgage rates, yield doesn't have it because people are cash flow positive on a lot of their properties, right? But I think what's interesting is now that you've had this rapid rise in rates, it's been met by a fall of or a decline in a lot of home prices, some areas very steeply.
Right.
So the opportunity is there, but having people wrap their head around, I'm going to get most of my gain from capital gain instead of yield is convincing them to go through short-term pain for long-term gain, which is a tougher sell because most people just aren't really used to looking at it that way. So where I find the least reservations is real estate investors. They get it. So they'll go in going, I can buy this property 80 cents on the dollar. So while everybody was kind of, on the sidelines waiting to go, I had real estate investors going, which properties can I refinance and how quickly can you get money in my bank?
Right. Bigger investors, not the individual ones for sure. But I would agree with you, and they're not buying pre-con.
No, they're getting those resales that've got to go. Like, yeah, exactly. There's not like an abundance of foreclosure properties, but there are some opportunities every now and then that need to move quickly. And if you have capital, they're right there. So we're seeing a lot more of like that conversation, and we still have a lot of buyers going through. And interestingly, some still go into multiple offer situations because we're finding that, there's more inventory hitting the market now, but the last couple months, it was very slim pickings. Like you didn't really, if you were looking for something particular, like there wasn't a lot of options to go around.
Well, interestingly enough, I still have to say there's not like a plethora of amazing inventory. That's the interesting thing. There's a lot of inventory, and I would say there's still some adjustment with people who are like, okay, but if I'm going to put it on the market, I still want to see spring 2023 prices.
Yeah.
It's very true. And I see it across the board. There's no question. The ones that are priced to reflect this market sell and will get multiple offers at times. There's no question.
Yep.
But I also, in the same conversation I was having with Jeremy on your team, he threw out a depressing, statistic or number was that, if you're someone in, let's say, the GTA buying a $1.2 million house, and there's not a ton you can buy for 1.2, but there are. Okay, there are some pockets, and you have to put 20% down because over $1 million.
Yep.
Your mortgage payment right now is $6,600.
Yeah.
And I was saying, like, my husband doesn't ask me like the details of everything, like I'll tell him stories or whatever. But he asked me, like the other day, like what's causing this? So I kind of gave him an overview. And when Jeremy gave me that, I said, honey, remember that question he asked me? And he just looked at me. He's like, oh my God, like right? So how much money do you have to, like, you have to be spending that much money on your mortgage on not a mansion. Like we're talking a bungalow in East York, right? Like that's what you're spending. So again, I still want to believe that the government's going to get us out of this in the next little while. What are you seeing are like some of the biggest changes from the regulators that have caused people to get, proof or less?
Yeah. So the first thing is that as you have rising rates, everybody's still subject to the stress test. So essentially, that your ability to qualify dramatically decreases when rates go up about 4%.
So everybody who doesn't know what the stress test is, so if you see a posted rate, let's just call it 5%. When you go to the bank will stress test you 200 basis points above. So they have to make sure that if it goes up, which is what was crazy for people who bought in 2001 or late 2020, was that they hit that trigger like quite quickly.
Yep. Actually, it was even worse, or it was even more steep back then, because what was interesting is, so in 2021, back then, like we were doing variable rate mortgages for 0.95. So you had like a sub 1% mortgage rate.
You can't see my face right now.
But I mean, full, like,
and
we
I'm
were
a variable person, by the way. I'm hurting like everybody else, but I'm like, I did not have a 0.95.
Yeah, but it's like we were telling people, full disclosure, like it's not going to stay there. Like our outlook at the time, the market was pricing in 2-3% in increases on rates. We ended up getting like 5.5, but no one saw that coming. But no matter what, nobody thought it was going to stay that low forever.
Right.
But what was interesting is that even at 0.95, OSFI came out and they basically put a floor on the qualifying rate. So if your mortgage was 0.95, you weren't qualifying at 2.95, which would have been what the stress test did. They basically put a minimum of like, it has to be at least the qualifying rate, which was 5.25. So you had to qualify at 5.25, even if your mortgage was 0.95.
Right, because that was more normal. They were like, this is on sale. Like literally,
exactly.
like so let's go full price plus the stress test.
So
that's smart.
So the benefit of that, though, is pretty much people on a variable rate had about almost 4.5% of rate hikes baked into their qualifying number. So thankfully, that prevented a lot of what I would say would have been much more defaults if people had been hit hard, because usually the bank will limit you at 44% of your income is how much can go towards your mortgage and debt payments.
Yes, I remember when I bought my very first house,
Yeah.
and I had an amazing real estate agent, and she said, the ratio is that actually one of the partner, like of the is their income goes towards. So you would say 50% of your total income should be going towards your mortgage, which I think people forgot about. Like, and I'm not blaming the victim, don't get me wrong, but I mean, I also side on this, like, I'm old enough to remember like my parents' generation being house poor. Like I remember, and they bought their houses for nothing. I bought, I probably get hate mail for this, but like I bought my very first house for $164,000.
Yeah.
At Marley and Eglinton.
Yeah.
Okay. Oh, I think I had like $15,000. I can't believe, and TD gave me a mortgage, but I remember the days where, you bought a house and you didn't go on vacation, you didn't get to go out to eat, and there was that term, house poor.
Yep. Oh, we still have it.
But I think it came back.
Yeah.
I think that we've experienced this very long stretch where people were not house poor, that could get into a house, that we experienced, 15 years, 20 years of very low interest rates when prices were still lower than they are now. Yeah. And you could buy it and you could still go on vacation. You could still have nice cars. I think that there is that element that people forgot that, 50% of your income does go to your mortgage.
One other thing that's really helped, though,
which I hope changes. Don't get me wrong. Sorry.
Hopefully it goes down. The percentage of income goes down. But essentially, what we saw a lot of too is that while we did see really increasing or rapid rate rises, we also saw really high wage inflation. So the amount of clients that we've seen where they're getting like their annual income growth is anywhere from 5 to 15 to 20%. Like there's some extreme cases where we see really rapid income growth. And it's interesting because as much as on average wages will increase, you always have to think that there's people at the upper end and the lower end of that average.
I was going to say, because that was, I would hear from parents of clients of mine who would say like, it's so hard for them. Like, they're making their starter wage is not any different than it was, 10 years ago, but the prices are hijacked. And so how are they ever going to afford it and that type of thing. So, for sure, there's a lot in play. But I do, going back to that, feel like, and maybe again, it's just hopeful and wishful thinking, but as much as you hear in the news that, the Bank of Canada has a inflation goal of 2%, they also have an interest rate goal, which they don't talk about. Like this interest rate can't just be all over the place. Yeah. They don't want it to be this high, right? It's their lever, but they still have a goal to bring it down. And so you guys do a really good job at forecasting this. So no one's going to hold.
One of our key pages.
It is, and I always
every month we republish.
It's amazing. So my question to you is, where did Perch at, let's say back in February? I won't hold you to it if you can't remember that month, but like earlier in the year, where did you see that like rate increase and then rate decrease kind of going?
So off the top of my head, yeah, I'd have to go back to know for sure, but I do loosely remember our March forecast. So the short-term outlook was actually more or less kind of still what it is now, where we're expecting hikes up until, let's say, like end of 2023.
Okay.
And then we'd start seeing a decline. So the one thing that's changed quite a bit, though, is that that apex, call it, of peak interest rates of Q4 2023, that's been the outlook since, I'd say, the beginning of the year. But I think the one thing that's dramatically changed is that the long-term outlook for interest rates has stabilized at a higher level. So we were expecting rates to come down about 2.5% over 2024 and 2025. That was back in Q1.
Right.
So now the outlook is that rates are actually going to only probably come down about 1, maybe 1.5% by 2025. So what's interesting about that is it kind of signals two things: is that the market expects inflation will stay higher for longer.
Okay.
And then it also expects that the Bank of Canada is going to have to sustain a higher kind of target policy rate to keep inflation in check. So we'll see how that plays out, but that's the one thing, like, we've seen the entire long-term curve essentially shift up 1%.
It shit up, all right.
Shift up 1%.
By the way, that's so going to be a short.
It shifted up 1%. Yeah, exactly.
Oh, I love that. That's so good.
This will be like on the bloopers.
Folks are just going home now.
Oh my God. So yeah, we're up 1% from where we were before. So that has very long-term implications, because that extra 1.5% of permanent rate increases, or like, not rate increases, but of a longer normalized interest rate is probably a better way to put it, means that everybody renewing in 2025, 2026, actually RBC just released a report a couple of days ago. I think it's something like 40-50% of mortgages are going to renew in those 2 years, including myself. So essentially that is a big difference of that extra 1.5% on your renewal rate is going to affect a lot of people's payments.
Do you feel, okay, so first of all, is it the market's forecasting? Like when you say that you're reforecasting, I'm always very interested because you hear like economists, you hear the market. Where is the forecasting, just for all the people listening?
So our forecast is we take the market consensus. So essentially we don't overlay our opinions on it. We just forecast what is the market pricing in. I obviously have my own opinions, but I mean, personally, I think rates will go down faster than it's expected in the second half of 2024.
And by the way, I'm really hoping and praying also, but I also feel like it really depends on whether we hit that recession and how hard we hit it.
I think it'll be a short-lived one, because I think it'll be very quick, and then essentially they're going to move very quickly to counteract it. So, I mean, but I think where it's going to be really interesting is the self-reinforcement of inflation, because it's kind of a self-fulfilling prophecy, because if you raise rates, you raise the cost of everything to a certain degree, right? Which feeds inflation. And then so housing, rent, all those things that are passed back to consumers are the byproduct of higher interest rates. Because why are landlords raising rents? Well, they need to cover their expenses, right? So if you start cutting rates, it is going to lead to lower inflation in some elements. So there's going to be this dance that the Bank of Canada is going to have to play, where they want to hit the 2% target. But if they cut too quickly, they might overshoot it and then have to start cutting faster to bring inflation back up if it goes below the target.
Interesting.
So I think I think we will see a bit of that, which is why it'll actually lead to an acceleration, I think, of rate cuts in 2024.
And I would say on that note, I feel like I want to look at a positive to leave everybody with, because it is a bit of a doom and gloom. And I think that I think that people understanding where we got to, how we got here, how we're going to get ourselves out of here, and why we will. I mean, even I was just talking this morning about it, like even Trudeau's backpacking. There you go. Shitting up,
Shit up and backpacking.
he's backtracking on his carbon tax.
Yeah.
And yes, he's getting pushback from, the premier. That's fine, but he's getting pushback because no one has money to pay for anything.
Yes.
So I think that, when you start seeing signs like that and you start, the leaders got us here, they need to get us out of this.
Well,
right?
you're seeing it on a whole other level too, because what was really interesting lately is that OSFI and the like essentially like many levels of government kind of started going ahead, because now the government, like the federal government, recognizes they need to really do a lot on housing affordability, and then at the same time, like OSFI was doing a proposal to go, all right, do we like tighten regulation further? And it looks like they kind of went, that's enough, like no more.
Well, no,
people
listen.
have felt enough.
And by the way, I think that's a great point, because I also think that's another reason why they're not going to raise interest rates on some level. They can and again, some of it is justification also. Even though the Bank of Canada is supposed to be like a regulatory body by itself, is they can stand on their soapbox and go, we did it.
Yep.
Like, we literally brought the market to its knees. We decreased average prices by X amount. So, like, they did what they needed to say. But when you have the Doug Fords of the world, and I think it was the Premier of Vancouver, I'm going to get it wrong, doesn't matter, open letter to the Bank of Canada going, cut it out.
Yeah.
It signals something. They're listening to the people every day going, we can't afford to put food on our table. It costs, everything costs more. We need your help. And the other reason I also think, what's coming up in 2025?
Oh, I think there's
an
an election.
election, baby. And you know what happens with elections?
It's very short memory.
Gifts.
Yeah.
There's gifts all around.
Yeah.
So I agree. I think 2024 is going to be almost like this, like going into recession, what's going to happen. It'd be like kind of a little bit like an all over the place. And then I think there's going to be a recovery, and they're going to start with the election promises and the...
Yeah. I mean, I guess, so
they
funny enough is,
always decrease rates right before an election. Like, I don't think there has been a single pre-election that did not have...
well, they'll stimulate spending, but the thing is so the Bank of Canada is an independent body, so it actually shouldn't be motivated at all by any politics.
It's not allowed to, but
I mean, the jury's out.
This one, I'm not so sure. Mark Carney, yes, but this one I'm not so sure. But yes,
but I mean, but to go against it, so funny enough, I mean, it might sound like doom and gloom, but I'm actually very bullish on the market, because I think right now is a great time to buy.
Sorry, yes, I meant to go there. Thank you.
Yeah,
please.
I mean, so not because yes, there's going to be a short-term uncertainty, but I think there's going to be a compounding of a lot of factors that'll lead to like rapid price appreciation, I think, in late 2024 all the way into 2025.
Well, I think that the demand is still there. Immigration is still there. That's not going to stop. We still don't have enough housing for people. We don't have enough housing for people.
We are not even close.
We're not even close. And so the reality is everybody hasn't changed their minds. They're just on hold right now.
Yep.
And so we have dropped dramatically in pricing.
Yeah.
As soon as those rates start to, and things shift, and the consumer confidence, and people are like, I think it's safe to come out now.
Exactly.
Truly. And I don't blame them for not wanting to, but I had a call with new clients the other day, and they're like, we're thinking we're going to get into the market for the first time. I'm like, you are so lucky.
Yeah.
And I agree. Right now is, if you can afford it, we always get the trolls saying that the real estate agents always tell people to buy stuff and they can't afford it. If you can afford it, you can go out there, you can put conditions, you can have a financing condition, a home inspection, status certificate, you name it, appraisal. People will take anything right now, and you can negotiate on price, and you have no competition.
Yeah.
And if I were to do a poll of all my clients that bought in 2020 and 2021, and I told them they were begging for that.
Yeah.
They were like, when are we going to be able to go out to see something and not have 300 people also looking at it?
Oh yeah. So I completely agree with you.
Yeah.
It's like you're going to see a lot of that, but then it's also going to be, you're going to have the compounded effect of the psychological reinforcement of rates getting cut, combined with, we still have very high immigration targets. Those will continue. We're not like, there's a lot of housing supply constraints, and they're going to get like, I forgot the stat. It was a huge percentage of the construction industry is due to retire within 5 years, labor shortages.
And also it costs so much money. Most of those condo
Yeah.
projects are on hold. Look at what happened in the Mizrahi project at,
Yeah.
at Bloor and Young.
So when you take away new housing supply from new builds, and then you still have demand, and then to your point, there's a huge difference. It's not like there's demand that's going away. It's just building up. And eventually that explodes, or like not explode, like it unleashes. Because if you have pent up demand, eventually it has to go somewhere. And if they all hit the market at the same time, that's, I think, will lead to like a huge turnout for housing. So yeah. And then if you have the recession and all these things we're looking at in 2024, that's going to lead to faster, an acceleration in rate decreases. So realistically, I think rates will stabilize in the mid 3s to maybe low 4s. Like I think in the next 2-3 years.
Yeah.
Sure, it's not the 1.9, that you had
Those are
before,
done.
but 3%, 4% is still
3%
very
is
affordable.
a gift right
Yeah,
now.
I mean, it's doable.
Gifts.
100%. So we have a lot of clients that get it. And what we're helping, I mean, so from the product side, what we're seeing a lot more of is a lot of people are getting alternative lending because they'll do up to 40-year amortizations.
Which is also crazy. Like if you'd
Yeah.
asked me 10 years ago if people would get it, I was like, no one does B lenders, right?
Oh,
it was
yeah.
like,
Well, not-
you literally had
not
to have
anymore.
like 0 credit rating. And
But we've
you know,
literally seen, we've been able to increase people's qualifying power by like up to 50%. Because if they go alternative, so, okay, and the easiest math I always think of is take $1 million house and then you put 20% down. Paying an extra 2% on the interest rate is roughly $1,600 or $16,000 a year on an $800,000 mortgage.
right.
1% price appreciation on $1 million house is 10 grand. So it's like, if you can, we just talked about the 10, 20, 25% discounts. So would you pay the extra $16,000 a year to net the $100,000 or $200,000 on the price? You have to really, that kind of all ties back to what I was saying about, you have to look at your total return. And some people see the value and they opt into it. And to your point, they can afford it. So affordability is a funny word because a high mortgage payment with a huge principal component isn't a lack of affordability. It's actually, you're basically just investing in your own asset. When you convert, like we're seeing a lot more high interest, but high amortization, which are effectively interest only mortgages in most cases. So arguably that payment's lower, but you're not building any equity. So I always kind of encourage people to look at the bigger picture of somebody with a huge payment, but that has a huge principal component. It's not a cost. Like it's actually just a reinvestment.
And on that note, what I want to leave everybody with is to check out Perch. Is it perch.co?
MyPerch.io.
Thank you. Got it wrong. MyPerch.io, because they have some incredible tools. And if you're thinking about getting into the market, no obligation, no nothing, no one. I mean, maybe you'll retarget them. Sorry. You'll turn your cookies off, but you can go on and you can play around, and they've got some amazing, amazing tools. And I was playing around with them with Jeremy this morning, and they're amazing. And they're not like what you would find at a regular bank. They're much more sophisticated. And you might be able to get some information, like surprisingly good information. Anyway, thank you so much for being with us. We'll include all of your contact information or the how to reach Perch. And we'll have to have you back to maybe reforecast what's going to happen in January.
There we go.
Because it'll be
Exactly.
a whole other ballgame.
Well, eventually we'll be on here and we'll be talking about the rate cuts that just happened.
Oh my God, won't that be great? And it won't be shitting up. All right, thank you.